All right, we can get started here. Good morning, everyone, and thanks for joining today's webinar. My name is Kylie Uehara from Enel, North America. We have two amazing panelists that we will be hearing from today. We have California energy storage experts Scott Motherland and Brian Quinlan from Enel. Today, we will be discussing how you can leverage DEBA incentives for your energy storage projects. Before we start off today's webinar, I want to give you all a heads up that we will be having a Q&A session. So throughout the presentation, if you have any questions, please feel free to submit them into the Q&A box. So without further ado, I'm going to hand it off to Brian.
Thanks a lot, Kylie. Thank you folks for joining today. This is a bit of a unique webinar for us. It's mainly focused on a specific geographic region in California, which is a unique opportunity with some state funding that's going to get approved. And truth be told, this is probably the only time in my career I'm going to be able to do this, but about an hour before this webinar went off, I got a quote hot off the presses message that this actually has been approved, or the funding has been approved amount. So this will progress a little bit quicker than we think, and we don't know when applications will go on. But as probably the only time I'm going to get a hot off the presses live on a webinar in my life, so I thought I'd utilize it. But before we start today, I just want to quickly go over and do some introductions a little bit over and above what Kylie said. So my name is Brian Quinlan. I'm an account partner executive at Enel. I help with our key customers sorting through both their energy and sustainability and coming up with solutions that can help them with either a combination of those strategies or individually in the energy or the sustainability side. Scott, do you want to give an introduction of yourself?
Absolutely. Scott Motherhead. I've been in the solar industry for about 18 years now. For the last 6 years, I've been here with Enel, focused on PPAs and solar plus storage and how we can use storage assets to lower the cost per watt on a PPA.
Thank you, Scott. And I think it's a good idea before to just kind of give a background of Enel and why we think we're a pretty good, I would say, subject matter expert to speak to both this funding and the solution we're going to talk about today. So Enel is a global company. It's very well known in Europe as it covers both utility, a supplier, helps private businesses both with their energy and sustainability. Things to note today are relative to what we're going to be talking about is storage. So Enel is one of the largest provider of renewable energy globally. We are also the largest purchaser of Tesla batteries globally for both front of the meter and behind the meter, so on-site and off-site energy storage. We also have the largest demand response portfolio both globally and in North America, which is a value stream that participates in the battery depending on geographic region. So this is a very integral part of our business, and it's something that both Enel with our partners and customers like yourselves, as well as working with the state and local utilities to put funding like this in place to actually drive the market forward. A quick overview of exactly all the different solutions Enel can support with. We think of things as offsite and onsite. So if we look at offsite, because that's not really what we're going to be talking about today, Enel can help with a retail supply. That's both whether it be green retail or just energy specific, depending on the region. We help with risk management, so consulting services, energy management, procurement, utility bill management. We also help with virtual power purchase agreements and power purchase agreements, VPPAs and PPAs, and that's from our utility, both wind, solar, and battery farms throughout North America. On-site, we look to help with demand response, so that's the curtailment of your energy as a product and using it as a revenue stream to support the grid in times of need or in emergency situations, as well as electrification of fleets and charging services, and that can be for customers, employees, or transportation, or electric school buses. And then today, finally, we are very interested and a large player in helping with on-site solar and storage, both globally but in North America. And so today's going to focus on storage, but we're going to tie into where solar can complement that. But the funding we're going to discuss today is primarily about supporting storage. So with that agenda, we want to go over what specifically is that opportunity and why is it important to act on it now? What are the value streams of solar and storage, and how to leverage the DEBA, which is the distributed electricity backup asset out of California, and then we'll go through a Q&A. So what is this opportunity and why now? So the market has been changing and quite volatile over the last 2 years, really since 2021. And one of the reasons for that is, unfortunately, when we think of electricity pricing, it can be affected a lot by natural gas. So uh, geopolitical hotspots that have come up, one of the big ones being for natural gas price in the Ukraine war, has really affected how the gas market has been operating over the last 2 years. And one of the bigger problems with that is we're not seeing an upper and lower bound that has been close together in pricing. And natural gas has a big effect on electric pricing. They're highly correlated, so it's something easy to track to know what's happening with electric pricing as a whole commodity. And so companies are starting to ask us about risk management, and the cost of energy is becoming a forefront in strategy instead of looking at it as a secondary input cost of the products they're producing. So looking at renewables used to be a sustainable conversation exclusively and has now come into both sustainability as well as energy risk management and how to hold the market moving forward about to be able to adapt to things that are changing, unfortunately, rapidly now. The other thing that has been concerned is grid cost management. And for a state like California, where we're specifically talking about today, grid costs have been going up, and there's been some rule changes on tariffs recently that are affecting people in costs in their bills, and they're seeing that in real time. And these are double-digit percentage movement that they're trying to mitigate against. And we don't see an avenue where that's going to improve itself in the future. There's a lot of electrification coming, and Enel believes that is the future, but the state of California is one of the ones leading the charge towards electrification. One of the great examples of that is they put by 2030, they're expecting all new vehicles to be sold as electric vehicles, and that's going to put a lot of stress on the grid from the demand side. So I expect to see some of those costs coming up. So we're going to go over today how solar and storage, but specifically storage, can help manage as the grid changes as a flexible solution. So one of the things, the main thing we're talking about today is the reason to act is because of funding. So there's financial reasons to use solar and storage to mitigate against the cost and volatility, but this is a unique time with federal funding as well as state funding. So I want to knock off the federal funding, and then we'll really focus on the state level. So the Inflation Reduction Act, which is a federal funding that helps support renewables, solar, and storage, has been a game changer across the country in all markets, but specifically in California, it's very effective with the subsidies to creating a renewable project to not be a cost center, but actually can be financially positive to input in for companies. So some key points here is at a bare minimum, companies will receive roughly about 30% in terms of tax credit off the capital of the project. And the reason for that is that's a base level, and folks like, well, if you're working with Enel, I should caveat this. At a bare minimum, if you're using wage and apprenticeship requirements, then you're getting the first block of these adders and a minimum of 30% ITC income tax credits towards the project. Now, there are adders in the IRA, which are unique to each individual location. So for instance, you could be in a disadvantaged community or in a brown power sector, and those will give you 10% adders. So you get 40, 50% or more off with these ITCs. And that's based off a map provided by the federal legislation towards it. And so you would apply for those, receive that, and can further improve the financials of the project. And that's something you want to start talking with a developer like Enel or other partners to see exactly for your location, are you eligible for some of these adders, which could really help in the financing of the project. Now I want to quickly overview the DEBA funding. So we're going to talk about it a little bit right now. We're going to go over exactly what solar and storage can provide value, and then we'll really dive into the specifics of DEBA and how we're presenting to apply to it right at the end of the webinar today. So the DEBA funding is quite unique. But as far as we can understand, you're going to be able to stack this funding with the federal. So you'll be able to take state funding, layer in the IRA we just discussed. That's very important because by stacking it, we're going to see a really big improvement on the viability of projects pretty much across the board in California over a certain threshold of energy. One of the unique parts of the DEBA funding that our understanding will be coming out is upwards of 50% of that can actually be covered by state funding. If you start to layer in that 30% minimum, we're talking a lot of initial costs, which is really what makes it difficult for putting these large energy assets in play, can actually make this project be viable for a lot more customers in California, in theory, to remove the demand from the grid and be able to stabilize some of that demand in stressful moments on the grid is the goal. So that the main concept here that I want to keep in mind initially is you can stack these fundings. We're going to stack both the state level and federal to go in there. But when we finish off the state, unlike the IRA, which applies to absolutely any business, the state DEBA funding has a fixed amount. And so we're going to want to make sure that you're in a good position to have a chance towards that fix, and we'll touch on it a little bit later. One of the reasons that we're putting a rush on this and putting a lot of pressure in the California market to get involved, and why folks should act presently compared to sitting and waiting and seeing what other funding or how the market will react to funding like this or over time with electrification, is that these types of fundings aren't going to last forever. They're generally designed to bring in a lot of infrastructure into the market, create a tipping point, or improve the market to a certain level, and then both state and federal won't need to fund the market for transitioning anymore. So the question for companies are, take advantage of both federal and state funding while it's available to put assets on your facility to lower your energy costs or improve sustainability, can give you a competitive advantage in the market. If you wait till that funding dries up, you could be at a disadvantage to your competitors who are able to put either energy plays or sustainability plays at subsidized rates. So I actually think with this DEBA funding, it's a rather unique call to action for anyone in California that is capable to look at storage assets on site.
Quite possibly my favorite slide. Thank you for that. We've seen so many of these fundings. They turn on, they turn off, they turn on, they turn off. SCHIP gets loaded and then was gone within a day. And then it gets reloaded again and it's on for a few months and then gets shut off. So I love that slide. So thank you very much. I'm twice as old as you and half as smooth.
Excellent.
So the value of solar plus storage. This is my section. Next slide, please. So going from left to right, flexibility of solar and storage is extremely important. On your far left, you have bill savings. A PPA is going to save your money on your bill, hands down. The cost of solar is less than utility. Your cost per watt, anywhere from 9 to 12 cents, is a deal. But with that, when you start adding battery to it, you're going to start reducing your peaks. So in the morning, you're going to have a peak before the solar turns on. And more importantly, in the afternoon, you're going to have a very large peak as the solar goes away. So these are the peaks that the utilities having a hard time controlling. So having energy storage to reduce those morning and afternoon peaks is extremely important in grid stabilization. Along with that, on the right-hand side, you have revenues. As you heard earlier, Enel is one of the largest demand response companies in the world. So the fact that we are a demand response company and that we have the smarts to run the battery, we're not competing for electrons from the battery. They're the customer's electrons, and we can sell them to the customer. We can sell them to the demand response market. We will do what's best with those for the highest value. So we will not be competing with a third party for that demand response money. And then incentives, yeah.
There's two things I want to just point out there that I think is something to take into account. A, that's optimizing you're talking about, but the other one is flexibility in these storage devices. And I would like, you have a lot of experience in the market, especially in California, that over time things change. And unlike a solar array, which just goes on and off, batteries can actually adapt to those market changes.
Correct. So, and then lastly, we have incentives. Brian touched earlier, we're talking about the IRA using to bring those prices down. And now today we're going to be talking about DEBA, which will bring those prices down even further. So next slide, please. So energy storage, what are we talking about? What does it look like? If you can all see the screen, this is a Tesla Mega Pack. We're one of the largest purchasers of Tesla in the world. And this Mega Pack here is built in Lathrop, California, carries 4 megawatts of power. in a very small place. This is 5'5" wide, 35 foot long. When I first started, this was 4 shipping containers, 40 foot long. And now a few short years later, you've got 4 megawatts in a very small space. And Tesla makes the great parts. You know, Enel is not going to make batteries. We purchase batteries from Tesla, and then we put our software over the top. We have the smarts. So the smarts do some amazing things. And the important thing to the facilities is it doesn't affect their operations at all. So the battery is going to sit in the background and work on keeping their demand response programs up to date. It's going to keep their KW down. It's going to work on arbitrage. It's going to do those 3 things. And it depends on which one's the best value. If it's not having to keep your KW, the facility, down, it's going to look for other places to make you value. But all it does is the intelligent software is going to sell into the best part of the market for you at any moment in time.
Scott, something I like to point out when the dimensions are up like this with partners we're talking about is your value per square foot of manufacturing equipment. And so when I look at the square foot footprint of a Tesla device, I think of the cost reduction per square foot or the revenue potential per square foot. And this is high value in a condensed location. Now, solar is great and has some real value in terms of renewable and production, but it takes a lot of square foot to implement
Correct.
meaningful amounts of solar, where specifically, if we're talking about storage, subsidized through state funding and federal funding layered in, you can get a lot of value in a small square footage from either cost reduction or revenue. So your value per square foot is high in storage devices.
Correct. This space is under 200 square feet, and the value is just amazing. For a standalone energy storage project, the cost per square foot or savings per square foot is just amazing. There are very few things you can install in a facility that'll save you that much money in that small space. So when you pair solar with storage, this is when the magic happens. If you have the ability to put solar on your facility and put a lot of it, Enel is going to use those storage devices to drive down the price of a PPA. We're going to use all those values and give you one single cost, which is a low cost per watt. So our PPAs are going to run anywhere from 20 to 25 years, depending upon what you would like. And like I said, we're using all the incentives, the DEBA incentives, the federal incentives to drive that cost down. Next slide, please. So quick example. On your left, you have a standard load. It starts off at 500 kW and it peaks out at 1.2 megawatts. Now, when we add solar to this load, you can see in the morning, you still have a pretty good peak, 900 kW, but it drives down all day long in yellow. And this is the solar production. And then late in the afternoon, past 4 o'clock, as the sun starts to set, the solar production drives away, and then you have another peak in the afternoon. So these peaks are real problematic for the utilities, especially the afternoon one. They're ramping up so many peaker plants to chase that afternoon peak. If you know anything about the duck curve, you know that the utility has to ramp up a ton of power. It's easier for them to shut things off. It's harder for them to turn things on to chase that ramp back up. So this is the problem with the grid in itself. So we introduced energy storage to help stabilize that grid. So you can see in this next slide, we've added battery to the slide, and the red is the battery. So first thing in the morning, it's going to reduce the peak down to about 600 kW, which is half of where we originally started. But the important thing is that peak demand line is nice and levelized all day long. So we were keeping it down under 600 in the morning, and then as the solar production decreases under 600, the battery's going to charge up. And then in the afternoon, about 4:30, 5 o'clock, it's going to have an excellent chance to do some energy arbitrage. It's got very cheap power in the battery. It's going to start discharging that in the afternoon, and then it'll start doing demand charge management, keeping it under 600 and lowering that peak in the afternoon. So marrying up the solar plus the battery has some definite advantages of cutting your demand charges in half and keeping them there. Whereas, the sun is hard to predict. It's not always shining. So batteries are, go ahead.
How I view this is, if you think about solar and storage, solar is a power production plant, but just like Scott was describing the utility, the utility has a difficult time at ramping up power and turning it off. There's no flexibility to choose when the sun is shining and when that power can be there. Storage is simply the ability to take that power or your facility's power in general and dispatch it at the most financially opportune moment for that given electron on that day. And that's where the smart Scott was talking about to optimize this. And if you look at that solar array time, they are discharging and charging in different moments to optimize that output of the battery financially.
So how are we going to leverage DEBA? Next slide, please. So as we understand it right now, DEBA, or the entire program, is going to have 931 million in it. But for our section, we're looking at the upper left, the 595, which is distributed electricity backup assist. So this is the DEBA at 595 million. Next slide, please. So it's going to start off with 545, but over 5 years, they're going to add another 50 million to it. You can see that on the left or on the right. But on the left, as far as behind the meter, the funding, we're looking for large scale energy storage projects of about 314 million. We have a feeling this is going to go very quickly. So, you know, people that get in their applications first are definitely going to have an advantage.
Scott, how much is 314 million relative to the California market is the real question. So if this was put in a different market with a lower population level and lower demand, that might be significant amount of funding relative to the cost of batteries. Correct. But what are we talking about in California given the industry there?
So average funding per project is about $750,000, roughly. So you're probably looking at about 500 projects that you'll be able to submit reservations for and get approved.
Which is not a lot given the size of the market in California. So to our point,
correct.
Fixed funding amounts at the state side with a fixed amount is an issue to be able to actually capitalize that. Federally, everybody gets it. But at the state level for this type of fixed amount, you want to make sure you're in an opportune time and moment in the application process to have the chance of being able to receive that.
So this program is going to launch pretty quick. We just found out that the CEC has approved it and it's going to be moving forward. We think that sometime in November/December, once they get everything figured out, they're going to launch and be able to start accepting applications. So how do we do that? First thing we want to do is apply for an application. We're going to put together a one-page document that you can sign that says we have a basic battery size. When the program opens, we're going to do our best to submit that and submit as many as possible. Once your funding is received, then we can start moving forward with the project. If funding is not received, we don't have a project. We get that. Then we're going to get into evaluating the economics of this. Can we add solar to this project? Is it just going to be a battery alone project? We'll make all those decisions then. And then we move forward into paperwork. So we're going to finalize agreements, move to contract. And from there, that whole time, we're going to be doing development. So we're going to be figuring out, can we get an interconnection here? Is the utility okay with us putting a solar and storage project here? Do we need to do any downstream work? Are there any problems with permits? We take care of all that before we move to our agreements. So we know fully by the time we sign agreements that we've dotted all our I's and crossed all of our T's.
So this is not a normal process to put together for a solar and storage project. This is a bit unique that Enel is looking at to put our partners in the best position to receive the funding. Normally, you would actually swap the evaluation of the project into an earlier stage. But the reason we're not doing that is because we actually do believe this funding is going to go quick, and you want to make sure you're going to be a first mover in the project, which see that segue there, Scott? That's a good.
Nice, very nice.
Thank you. That was want to be a first mover in the project because we think that funding is going to go, and so you want to be at the front of line. And from Scott's experience in the past with SGIP in California, the previous funding to support storage, we literally could watch that funding just drop down hour by hour to go to zero, and it was just whoever was getting in the queue as early as possible had the opportunity to receive the subsidized funding. But if the project didn't move forward, the funding could be returned to the state. and roll back into the program. And we're expecting DEBA to be similar to that. So it's not an obligation. So that LOI process that Scott just described, we're making it as no risk as possible, i.e., hey, let's all apply for this funding. Let's be a first mover right off the start when it can go out there and get application into the state. Should we receive the award for the funding, do a full evaluation to give both Enel and our partner the ability to understand the economics of the project and is it right for your specific site or sites, and at that time make an educated business decision to move forward with the project with state funding, then evaluating the project without state funding. But to Scott's point, if at that time everyone decides it's not in their best interest, it's not something that your specific facilities want to move forward with, no big deal, return the funding. Enel's more than happy to get us to that point because this is a bit of a unique offering at no cost. And if we go our separate ways, no big deal. But if we move forward with that, that's where our interests lie. We really want to help bring these renewable assets into the market. We want to help customers put these energy assets on their facility to manage energy load moving forward. So what we're asking for folks is reach out to Scott, reach out to myself, and we'll put our emails up, or call their local, who's ever running their procurement, to reach out to their Enel rep or someone else in the market to start talking about how are they going to apply to this application and be in the front of the line, because I think it's going to go very quickly, and you want to make sure you're first mover to be able the opportunity to make a storage decision with applicable subsidies to make it financially viable for you. So with that, we're going to move into the question period. I've got a few questions that were submitted prior that I can go through. If you have any others, feel free to put in the chat and we'll try to answer those in real time. But Scott, I think I'll ask you this question and then I'll jump in and see if there's anything I can add to it. You've presented a lot of upside in terms of why now and how much DEBA and the ITCs will drive down costs, but what is their downside? So what downside risk is there for a partner to get involved in this or to move forward with the project?
I think the downside is you're going to miss out. This is going to be an incredibly low cost. It's going to be an incredible opportunity, but down the line, when it's required, there won't be any subsidies left. So I think it's missing out is the downside.
Or more expensive to actually do energy risk management in the future, which it still will be profitable, but your entrance capital costs will be higher into the market.
I think in the very near future, it's going to be mandated for California that you're going to have to do solar and or storage and or cost mitigation, something along those lines. So take advantage of it while the subsidies are out there now.
The next one actually is we didn't touch it in this presentation yet, so it's probably good to go over exactly the different types of financing options we have. Will my company incur any costs outside of the project costs?
So no. We're going to wrap all the project costs up within the PPA and explain to you everything. We've done roof repairs within project costs. We've done panel upgrades within project costs. So it's a zero down PPA, and we mean that. So you're not going to get charged until that system starts producing power, and then we'll charge you cost per watt.
And that's full, right? Like on-site electrical work, on-site installation, on-site pre-work or boring of any electrical to panel. This is true kind of start to finish. Enel is more than happy to put up all the capital for the project, but if companies want to own it, that's perfectly fine as well. But it's your decision whether you want to put capital up or use your own company's capital for your main business. And Enel, since we're in the energy business, put our capital up to put energy assets down throughout California. Okay, I'll move on to the next one here. What would be the initial steps and what we're expecting to go through this application process? So I think I probably can start that one off. So normally we would start evaluating and going through a teaming process to put an application in. But in this instance, we think this is going to be quite the race in this first iteration of DEBA funding. And what we really want to do is make sure we're in the best position to apply, and that's that LOI. So it's really just a letter of intent for us to look at your company and figure out a sizing of an appropriate storage asset to put you as a first mover in the queue to the DEBA funding the very moment it opens. And then we wait to see whether we get accepted for the funding to then further put assets and development dollars towards evaluating the financial implications of that device for your facility. Now, up until now, you have not signed any agreement, which means even at that moment of winning the funding, you can walk away from it. Okay, we got one more question here, and then so far I don't see any others, so this might wrap it up for us, Scott.
Okay.
How are the DEBA funds distributed? Is there any upfront cost reduction, tax incentives like the ITC? They're just curious as to how the funds would get handed out.
So ITC is going to be year one. You're in your next tax year, we'll collect the ITC, or if you're going to do a cash purchase of the project, you will collect the ITC. But DEBA is a little different. So DEBA is going to be a performance-based system. They're going to give you, it looks like right now, by the way it's written, 25% will happen as soon as you turn the system on or within a few months. And then you will get the next 75% over the next 4 years. So it'll be divided up into 4 payments after that. And it'll depend upon performance. It's got to perform within those, the periods that they want it to, which are going to be when the grid is stressed. And chances are when the grid is stressed, you're already pushing power into your facility via arbitrage and or demand charge management because you're trying to keep your demand down. So it'll be a performance based over 4 years.
And then the one other question is whether we're going to share a recording of this, and I'm actually waiting to see the answer for that.
I see the 3 dots
from
going.
our marketing organizer, if that's possible. But while she's putting that up, it is possible, Kylie. We'll be sending it out.
So after this, we will actually, usually an email will come out with the recording as well, but we can also reach out to you directly with a recording link as so you can view it and share it with anyone.
Okay, perfect.
Excellent.
And before we wrap this up, if you folks can take a screenshot, write this down, highlight whatever you do, either Scott's or my email, or reach out to your local NL rep if you're working with someone already as a demand response partner. Just open the conversation to see if this is potentially right for your business, as this is we're viewing this as a sprint to application versus a slow rollout of a potential energy asset. Let's sprint, let's get in line, let's have the ability to actually have your facility rewarded DEBA funding, and then at that moment, let's make an intelligent business financial decision with state funding versus without. So I want to thank everybody for their time today. Very much appreciated, as I know we're pretty busy. Oh, one more question rolled in. It's actually a really good one, and we should type it. We should put to it. Scott, can you do something if you already have solar on site? And this actually is timely.
Oh, absolutely. Yes. Coupling a battery with existing solar. Yeah, that's something we absolutely can do.
Yeah, do you want to just quickly describe, like, more or less, that's your dream scenario, right? If you don't have solar, big benefit coming into play, putting solar and storage come in there. So that's actually the best scenario. But if you happen to have already had solar, good job, you're making progress that's going in there, and then maybe describe that integration is fully what you're talking about, maximizing that.
So again, we'll take your facility's 15-minute data, we'll take a look at your bills, and we'll run that and give you an optimum size of a battery, tell you how much it's going to save you in demand, how much it's going to do in demand charge management, and then how much you're going to make in all of our DR programs. You can either buy this CapEx from us, or we can do what's called a shared savings at that point. So a little bit different from a PPA, because you've already either have a PPA with the solar or you've bought it for cash. But if, let's say, the battery saves you $100,000 per year, we're going to figure out what a good split is so that NL can receive back all their money that they put into the project. Again, you're not putting any money down. We're going to install it at our cost, get it up and running, and then every quarter we will rebuild your bill with all of the dispatches from the battery. We saved you $100,000, you're going to owe us 50% of that, or whatever appropriate split we come up with so that NL may receive their money back. But it'll all be driven around savings. So when you save, you pay. If you don't save, you don't pay. It's a very safe investment.
And then I've got one more that came in as well, and there already is solar installation going in play, but it's not live yet. And then someone's using different developers for a best option, which is battery storage for other folks on the call, and they'd like to compare with Enel. Is there a way for us to expedite this process? And the answer is yes. Please reach out to Scott or myself on this call, and we can put together another option for you to see about how you can actually optimize that solar and storage installation, which I think is Enel's bread and butter of putting that unique solution together. So please reach out, and it's definitely something we can do in an expedited timeline for you. And I'm going to hopefully not eat my words for a third or fourth time, but I think that is it. Questions?
Good.
And I'd like to thank everybody for today, for coming in. Feel free to reach out at any time. We're happy to help. We really want to put folks in position here to get a lot more energy assets put in play in California. So please reach out if you have any time, and thank you very much. Thank you, Scott. Thank you, Kylie.
Thank you.